Hello and welcome to AdaPulse, the channel that brings you all the news and all the proposals that are in and around the Cardano ecosystem. Now, before we go on, please do remember to like, share and subscribe to our news channel and hit that bell notification too so you can get notified as soon as we've got some content available. And don't forget, you can further support us by delegating your ADA to either Swag, Zod or me, ATM. And do comment below. We'd love to hear your feedback on the content and we'd love to interact with you as well. Now, so today we're discussing the bear market survival guide. As usual, can be found on the AdaPulse website, and I'll include a link to it below. And this is by FLANTOSHI from the AdaPulse team. Now, bear markets are where fortunes are made. So, let's go and make some money. Until recently, we were in the longest bull run in recorded history. And for good or ill, it warped our expectations of what we should consider as normal in the markets. So today, we'll explore how our warped understanding is making us make critical investment errors now that the rules are changing, as well as how to structure yourself wisely to perhaps not only survive in the bear market, but also thrive in it. Setting the stage. Now, if you're under 40, you have likely never been invested during a deep recession. The last one was in 2008 when I left uni, and due to some very clever financial alchemy, the financial apocalypse was postponed. The Western world started a complex money printing program known as quantitative easing, which essentially relied on purchasing debt and thereby reducing the interest rates. It was so low that debt servicing rates occasionally went negative. So financial entities were sometimes paid to borrow money. It became known as helicopter money or free money. But the point is that this state of affairs propped up the boom over the next decade. It was so successful that it led to the longest bull run in recorded history, despite the fact that many financial metrics, even prior to this market downturn, barely matched the heights reached prior to the greatest recession. In other words, we've lived in a world where stupid financial decisions weren't punished and sometimes even rewarded. During this decade, it became common for companies to develop and have no clear path to profit, as they were confident that the infinite investor money would keep them afloat, for the foreseeable future. Everyone thought they were geniuses, and people thought that this would, last forever. Then came COVID. And with lockdowns and the money printer on overdrive, average people began to wonder whether the economy as a whole, wasn't built on thin ice. To succeed in this post-fantasy land environment where reality is viciously reasserting itself, we must unlearn the stupidity of the last decade and be more sensible about things. Unlearning bad habits. From circumstantial evidence, we're led to believe that most of our audience is under 40. I'm actually 40, but that's a chat for another day. This means that even if you have been in crypto since its inception, you've not really participated in a proper recession. Sure, you might have experienced drawdowns and prolonged bear markets in specific assets, but other sectors of the economy remained viable and profitable. Not only that, but some Western countries like Australia sidestepped the Great Recession in its entirety as they had demand for their resources from unaffected countries like China. But this has meant that a whole generation of professionals believes that assets only ever go up. At the moment, it's not rational investment proposals that rule our investment decisions, but FOMO. That's fear of missing out, if you didn't know already. Fundamentals matter so little in this state of affairs that we have JPEGs worth more than the price of a house. And the vast majority of the public invested in assets barely cares how they work or whether the business model is sustainable. Crypto, for instance, is often referred to by its investors, number go up technology. However, reality is reasserting itself and we can't afford such willful ignorance any longer. Instead of gambling and trading, we now have to go back to school of value investing, where you pick assets with solid fundamentals and stay there for many years if necessary. You can't just go in and out whenever you feel like it and still claw a profit. Just to make a point, the international bank JP Morgan made the argument that had an investor purchased an index fund from the S&P 500 on January the 3rd, 1995, 10 years later, they would have made an annual return of 9.85%. So let's say 10%. Nevertheless, had this investor missed the 10 days within this period, they would have only made 6.10% return. Worse still, 6 of those 10 days were within 2 weeks of the worst days. This means that one would have surely ended up missing the 10 best days within that decade had one tried to, time the market, and it would have cost them 40% of their potential profits. In other words, an entire decade's worth of investing results might come down to not making dumb mistakes during critical periods. Given the insane volatility in crypto, this is probably far truer in this industry than in traditional investing. So as much as it has become a meme in the crypto world at least, to hodl, which stands for hold on for dear life, or to not trade your assets and keep them for long stretches of time, it does seem to be the winning strategy forward. Find a good project with a solid business model, a decent chance of success and a good team, invest in it and wait. The era where you could just gamble and go in and out of projects while making insane profits has likely finished. Every percentage gain will cost us, and returns are definitely not guaranteed. The kiddie pool of easy money is closed. Now you must swim in the shark-infested ocean of uncertainty if you want to make any profit. To do this successfully, though, you will need a plan. How to bear-proof your investments. First things first, it doesn't make any sense to potentially strike it rich tomorrow if you can't actually survive until then. So in other words, self-preservation ought to be the priority during bear markets instead of profit maximization. This will necessarily mean investing in safer, more boring assets, but dare I say it, not invest at all. So with a name like AdaPulse, you could expect a Cardano shill account, but ultimately we care about the well-being of the people that have trusted us enough to be part of our audience and community. We don't take our viewers or readers for granted, and we all, and that's from the founders to the writers and to myself, genuinely care what you guys are doing with the information we give you, and don't take our responsibility of fair reporting lightly. Now, some argue, FLANTOSHI in particular, you should not invest in anything in these choppy waters unless you have 6 months worth of living expenses set aside. The counter argument to that is, that's okay if you've got the money, or maybe even it sounds classist or elitist. Like, do you not want poor people to make life-changing amounts of money, FLANTOSHI? But I think the point being made is life-changing returns, that's probably more common with crypto than anywhere else, are by no means guaranteed. So he wants people to preserve that little wealth they have and obviously not go into debt. 6 months worth of living expenses gives you just that. So enough breathing room to not make dumb decisions if you get fired or have a unexpected expense. So you don't make financial decisions based on your current cash flow. If your kids are hungry, you're going to cash in, despite it being half or even quarter of what you paid. But more generally speaking, you don't want to be making emotional decisions in anything that involves money. So don't put yourself into situations where it's inevitable that you'll have to make emotional decisions. So, of course, another counter-argument for this is that inflation will eat away at your reserves. If the economic crisis ends up manifesting as stagflation, hyperinflation, or the old classic inflation, this is a fair argument. It's possible, or maybe even likely, that a portion of your cash savings are going to be eaten away by inflation, even if it's in tier 1 currencies like the US dollar, euro, or the British pound, whatever. To reframe it a little bit, it's not your savings being eaten away by inflation. It's you paying like an anti-homelessness insurance policy. So when you put it in that context, the fee at least looks somewhat bearable. In either case, let's assume that you've managed to save up 6 months or even a year's worth of living expenses. What's next? Well, I'll tell you. How to jump into the markets. Now, let's assume that money's of no concern and that you're not going homeless anytime soon. How do you best allocate capital into a situation like that? Well, I mean, it primarily depends on your school of thought, but also, your particular life circumstances that you have. But let's just start with the money itself. I mean, imagine your rich uncle died and gave you a pile of cash. What do you do now? So, for practicality's sake, we'll just say, you want to throw it all into crypto. Now, here's a bit of a contentious discussion. Some people advocate throwing it all in one lump sum at once. The sort of thing I would do, but that's mainly down to my laziness or excitement to just put it all in, But while others advocate putting it in slowly. Now, the second option is known as dollar cost averaging, or DCA. And it involves putting fixed amounts at preset intervals, thereby getting a good price on average, as you're buying when the market is low and high. Now, there are good arguments to be made for both camps. The conscientious lump sum camp will likely mention the old investing maxim, which is time in the market beats timing the market. And they'll point to some research where a handful of days in a decade account for a disproportionate amount of the returns, like what we mentioned earlier. Now, on the other hand, the DCA camp will point to the fact that if you happen to invest at the wrong moment, you might have jumped in at like the all-time high, for example. As such, had you waited even a day, you have been able to buy double the amount of assets. So according to them, investing gradually is the best option, given that we only know in hindsight what prices were low and high. But bear in mind, it's not a binary option. I mean, why not do half lump sum and half DCA, or whatever proportion you're comfortable with, weighted towards whichever argument convinces you the most? The broader point is that you need to pursue strategies that don't just make sense on paper, but allow you to sleep well at night. If an investment makes you lose sleep, then whatever you paid for it is clearly too much, if you know what I mean. The sad reality. Unfortunately, most of us don't have a rich uncle that wants to give us, unfathomable riches. If we're lucky, we have a paycheck. In other words, past the initial considerations of whether to throw in your savings or doing it gradually, you're more or less probably forced into a kind of pseudo DCA strategy anyway. Now, you could do this in the relatively blind and boring way of earmarking a fixed percentage of your salary onto this and putting it in every preset period, or you could be a bit more creative. I mean, as the first strategy is somewhat obvious, we won't spend much time discussing it and instead just focus on the second one. Now, I don't know if FLANTOSHI came up with this strategy, but it's not one I've come across, so I'm going to work with his terminology. I mean, the short of it is that you take the money you have available and set limit orders for them at lowball prices, and then just wait. He calls each order he makes a bear trap. So, in other words, what the bear trap is doing is create a descending ladder of prices that will trigger whenever there are downward shocks. Worst case scenario is that they don't trigger and you keep your money. It bears mentioning, though, that there are ways to get ahead of this crowd, even with this passive strategy. So, for instance, people have a bias towards certain numbers, like anything ending in 0 or 5 are often support areas as people default to them. So set your buy orders for weird numbers like ending in 3 or 7 to get ahead of the rest. Don't be shy and put them at much lower prices than you think are possible. Let's say ADA is at 80 cents and perhaps put it in at 67, 63 or 52 or whatever. There's also nothing stopping you from changing the orders to numbers that you would prefer. For example, if your money's tight, you might prefer to only part with your cash in a really good price. So set a buy order that's bigger than the rest at the bottom ladder that you've built. This is primarily meant for people who already own a decently sized bag of the asset they're interested in and wouldn't mind purchasing more, at a lower price. So it might be a little bit too passive or unreliable for someone who wants to guarantee that they'll end up with the asset in question. So it's worth remembering that, especially in bear markets, inaction is a viable and often effective strategy. I say this from experience, as I'm well known for my impatience, and like I mentioned earlier, I tend to get excited and just jump straight in. If you don't know where the wind is blowing, perhaps it's worth, standing still just to get your bearings. And don't buy or sell if you don't need to, and only when it fits your risk tolerance. I know the bear trap strategy is the main way FLANTOSHI accumulates. During good times, he deposits money into his centralized exchange or SEX account, puts in low orders, and then just waits. So in a very roundabout way, his sex account works kind of like a bank account. So often he catches those, flash crashes down to, like a super low price for a few moments, and he catches it. I mean, otherwise, the orders might stay there for a few months, and he seems to be fine with that. I mean, the trick is to make this accumulation strategy as hands-off as possible, so that even if he were to die, the bear traps are still actually working, so his family can still cash in. That way he doesn't need to look at the prices or even think about it. Parting thoughts. Overall, we don't know what the future holds before us, and we don't know the particular flavour of the economic calamity that might or will happen. What we do know is that we want to be prepared for whatever happens. I mean, you might not be driving Lambos soon, but you'll have a roof over your head. And people, you do have to remember that does count for something. I mean, and furthermore, great fortunes don't tend to be made during boom times. It's at times like these when everyone is running from investment. In moments like these, markets can massively misprice assets as they overreact to the short-term variables and kind of underplay the long-term trends. The best form of investment is one done as detached as humanly possible. Don't put yourself in a situation where your emotions are guiding your decisions. Yet before blindly doubling down on any given strategy you had been following during boom times, it's worth asking yourself whether your investment thesis is still true. Are the premises under which you made the investment in the first place still valid? And will they continue to hold power for the foreseeable future? If yes, then draw up a plan, settle down, and be prepared that it's going to be a bumpy ride. Don't assume that because some asset has gone down, its all-time high is indicative of any future prospects. It might never recover. So don't throw good money after bad. Really think about whether something has a future. Besides that, all we can say is good luck. We're all going to need a bit of it before this is over. And that's it for today. Remember, the full article can be found on the AdaPulse website, and I'll include a link to it below. And remember to like, share, subscribe. That's the subscribe button up there, so do hit that. And do comment as well. And remember, you can further support us by delegating your ADA to either Swag, Zod, or myself, ATM. So that's it for today. Thanks for joining us. Bye.